The list of market horror stories in 2022: equities, bonds, long-dated index-linked gilts, credit, and cryptocurrency. The credibility of the central banks, though, was perhaps the largest loss this year. Central banks are financial institutions that are responsible for regulating the monetary policy of a country, and they play a crucial role in maintaining financial stability and promoting economic growth. However, in recent years, there has been a growing debate about whether central banks are actually failing in their mandate. Their inflation predictions have been dreadfully off-target since the start of the coronavirus outbreak and Russia's invasion of Ukraine. They were sluggish to react to the quickly growing price level, and in the remarkable example of the U.S. Federal Reserve, they were initially apprehensive. According to popular thinking in central banking, supply-side shocks like rising oil and gas prices, shutting down of ports, and closing of semiconductor factories should be seen through because they only have a short-term influence on potential output. However, it is obvious that the deglobalization and other supply shocks and inflation will result in a long-term decline in potential output. It is the responsibility of monetary authorities in such situations to tighten so that demand is brought into line with the decreased productive capacity. One of the lessons learned from the cost-push inflation of the 1970s following the initial increase in the price of oil was that supply-side shocks can also, in the words of central bankers, de-anchor inflation expectations and have second-round effects on labor markets. Recent blunders in monetary policy may, in part, be the result of generational memory loss. Few central bankers working now were battling inflation after the 1970s oil shocks at the barricades. Undoubtedly, another reason was overconfidence following years of low inflation. To be fair, it must be acknowledged that the initial attempt to tighten policy was incredibly modest because it is notoriously difficult to judge an output gap in real time. The Fed Vice Chair Lael Brainerd highlights the extended series of shocks to the supply of labor, commodities, and essential inputs like semiconductors. The difference between a temporary shock and a sustained one to potential output became blurrier as a result. The result of all of this is that central banks no longer have any authority. Due to the significant mark-to-market losses that increasing rates are causing on the enormous bond holdings that have been amassed since the financial crisis of 2007 to 2009, their delayed policy tightening is also hurting their own balance sheets. There is a huge spectrum in reporting practices, thus not all central banks will record these losses. Many would counter that they are not profit-maximizing organizations and that they can function just fine with negative equity. They have the ability to print money, thus they cannot fail. However, there may come a time when markets start to worry that a financial crisis may result in high or hyperinflation. By requesting funding from finance ministries, central banks may lose some of the independence they have since the financial crisis. The Bank of England was exempt from this, incidentally, as it requested and got a treasury indemnity for losses incurred during the crisis. The state of advanced economies is so unpredictable that there is a possibility of both monetary overkill and underkill. An economic downturn in 2023 might highlight the financial insecurities brought on by the protracted period of ultra-low interest rates, during which investors sought income regardless of risk. Central bankers generally agree that while bank balance sheets have improved since the crisis, the risk has moved to the non-bank financial sector. There is considerable truth to that, as evidenced by the September gilt crises revelation of the growing leverage in the UK pension system. However, there are also significant and mostly opaque off-balance sheet risks in the banking and non-bank financial sectors, particularly with regard to dollar debt in foreign exchange swaps, futures, and currency swaps. Claudio Borio, Robert Macaulay, and Patrick Maguire note in a paper for the Bank for International Settlements that the stock of dollar treasury bills, repurchase agreements, and commercial paper put together is outnumbered by the $85 trillion in outstanding obligations to pay dollars in these instruments. Since the financial crisis, there has been a dramatic increase in commitments, most of which are relatively short-term and frequently include maturity mismatches in institutions like insurers and pension funds. Rollover requirements as a result lead to financing shortages in dollars, as was the case during the financial crisis and in March 2020 at the commencement of the pandemic. These dollar payment commitments are absent from normal debt data and balance sheets. There is a clear potential for disaster here. The current consensus in the market is that the central bank's policy of tighter for longer will keep bond rates increasing and stocks declining. The main question is whether central banks would feel compelled to resume asset purchases in the event of a financing crisis in order to support markets and financial institutions, weakening their anti-inflationary position. Such a turnabout would be the highest form of central bank revisionism, thereby reverting to morally hazardous asymmetric monetary policy. The fact that it is so believable raises concerns. Also, some people believe that central banks are failing is due to their inability to effectively stimulate economic growth. Despite the use of unconventional monetary policy tools, such as quantitative easing and negative interest rates, many countries are still facing stagnant growth and high levels of unemployment. Another reason why central banks may be failing is that they have become too focused on short-term goals, such as stabilizing financial markets and keeping inflation in check, at the expense of long-term growth. This has led to a situation where central banks are constantly reacting to crises rather than proactively addressing the underlying structural issues that contribute to economic instability. Furthermore, the increasing reliance on central banks to solve economic problems has led to a situation where they have become too powerful and are able to influence not just monetary policy, but also fiscal policy and social policies. This has led to concerns about the accountability and transparency of central banks, and whether they are truly acting in the best interests of the general public. In conclusion, while central banks have played an important role in the global economy, there are valid concerns about whether they are failing in their mandate. It is important that we continue to critically examine the role of central banks and ensure that they are accountable and transparent in their decision-making processes. Thank you for watching our video. We hope you found the information we presented to be insightful and informative. If you have any further questions or comments, please feel free to leave them in the comments section below. Don't forget to like and subscribe to our channel if you enjoyed this video, and be sure to check out our other videos for more analysis and discussions on current events and issues. We'll see you in the next one.